Test, 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 test. Testing, testing. Okay, all right, here we go. All right, so we were just talking about how the IMF put out information this morning, right? But before we get started, since you didn't hear me before, I'll say it again that this is your room, so please feel free if you do have a question. For example, on fundamental analysis, maybe you want to know how fundamental analysts model currencies, or maybe you have a question about technical analysis, about an indicator or a pattern, or how to deal with a particular situation in technical analysis. Just let me know. Or maybe risk management, the most important part of your trading world is risk management, right? So we want to definitely include that. Okay, so the IMF, International Monetary Fund, put out some information this morning, and it created a little jolt in the market. Nothing terrible, but just remember the IMF is not known for their accuracy in predictions, but we can't ignore them because they do move the market. The IMF is saying that U.S. growth will slow to 2.5% in 2019 and to 1.9% in 2020 because of the unwinding of fiscal stimulus, higher interest rates, and U.S. trade war with China. Now, if you listen to the first segment today, we pretty much debunked the whole trade war with China issue. The trade war with China, first of all, the IMF is suggesting that this trade war is going to go on for years. It's not. It's a negotiation, and it'll get solved. It'll get hammered out sometime before 2020. I'd love to tell the folks at the IMF that. Also, right, they did said that they're very concerned about China's economy. China's growing at 6.4 now, by the way. 6.4, not that great, right? Not a great number. All right. As for Europe, IMF is more bearish on growth. Only going to grow 0.7 in 2019. Man, that's pretty sad. With 0% interest rates, too. 0.00 ECB rate. The IMF says the best that Europe can do is 0.7. That's pretty bad. But they expect it to pick up in 2020. Lackluster growth in Italy, France, and Germany, and policy tightening in Turkey are the reasons behind the downgrade of Europe. So really, I mean, this is just a gloomy, gloomy report. Let me give you my version of this, okay? This thing is wrong. All right, U.S. growth will be okay because the trade dispute with China will be resolved. It's a negotiation, and they will negotiate a settlement. That will get fixed, and that'll cause the U.S. to maintain around 3% growth. And because the U.S. is growing at that rate, that's going to be good news for Europe. Europe does a lot of business with the U.S. They'll be getting a lot of orders from the U.S. So Europe will be not 0.7. It'll be at least 1% growth, which is still pretty bad, but it's better than 0.7. My God. All right. So, and as far as China is concerned, man, I mean, if the trade war with the U.S. is hurting them that bad, they ought to settle it. They're at 6.4% GDP. China's kind of a wild card. I can't tell you what's going to happen in China. I know that whatever is happening there right now isn't good. You know how I know that? By looking at this chart. What is this chart? This is copper. China consumes more copper, far more copper than any other country in the world. So when the price of copper is rising, that usually means China is buying more. And when China's buying more copper, that means they're building things. The economy must be good. When the price of copper plunges, like it does on the left side of the chart, that means China needs less copper. They're building fewer things. And you can see that although copper has been stable lately, it has never recovered from its sharp loss. And it makes you wonder, if there really is a serious problem in China. So really, I think the U.S. is just fine. I think Europe is better than the IMF believes. I also think the U.S. is, obviously. But China, man, this chart scares me. They call it Dr. Copper for a reason, right? When economies are going bad, they use less copper, and that tends to drive the price down. When economies are going bad, they use less oil, and that tends to drive the price down. Look at that chart. This is U.S. Crude oil, U.S. West Texas Intermediate crude. You look at that plunge, October, November, December, the price of oil, the bottom just fell out. So what does that tell you about the global economy? It's not good, right? There's something wrong. China consumes a lot of oil too, just like they consume a lot of copper. Maybe China's consuming less oil. Of course, the price is coming up now, but why is the price coming up? It's not because demand is rising. It's because countries like Saudi Arabia are reducing supply. And there you go. And the price of oil, the price of all these things is nothing but the supply demand equation. and but the reason why oil is going up, it's not because of increasing demand. Increasing demand would be good because it would speak to a growing global economy. Instead, it's less supply as countries like Saudi Arabia try to push that price back up. Okay. Anyway, so I'm not really too keen on the IMF, but it's kind of interesting to look at these charts and to see where um, oil and copper are heading, where they are, where they're heading. When I look at this chart, I think about Fibonacci, really. Look at that drop. You're getting awfully close to the 32% retracement, 38.2 retracement. There's also some resistance in there. You know what? I gotta adjust this. Hold on 1 second. All right. I want to get right to the wick on both ends of this so I get the accurate Fibonacci reading, the most accurate that I can get. There's your 38.2, right? It's at approximately $56 a barrel. We're getting close to 55. I have no idea if that's going to hold, but I can tell you that 56 was also a significant number for support right in here before it broke, right? It held up there a little bit back in November. So there was some support there. There should be some resistance there now. Plus, you're coming up to the 38.2 fib retracement. So oil could hit the wall here, which means if oil is going up, what does that usually mean for dollar CAD? It usually means dollar CAD is going down. Usually. Is dollar CAD going down is the question. Sure has been. Wow, has it ever? Okay, but if you really believe that oil is going to hit resistance, then you also probably believe that dollar CAD is going to hit support. And isn't it funny how I can draw a Fibonacci in the opposite direction and bam, you've already bounced off of that 50% area, right? Which is not a Fibonacci number per se, but we have had a 50% retracement of this rally which by gosh, that makes USDCAD a lot cheaper, doesn't it? You know, they gave back half the rally. And that means it could be time to buy, quite frankly. I mean, you look in this little area here. Okay, well, first, big picture, right? Big rally, 50% retracement. And what's happened since then? It never seems to fall below the 50% retracement. Somebody likes dollar CAD down there. All right, so let's get zoomed in on this area on the right, because I'm thinking the next move is probably higher, but it might be a breakout trade. We'll see. That could be exciting, right? Could have a very exciting breakout trade coming up here. Let's try to get that shaded, the fill color. Let's make that yellow area. You see that yellow area? It's percolating in there. And if it could break out of there, which is very close to breaking out, if we can break out of there, it could be a buy. So let's zoom in on that square. First, I'm going to go down to a 240 minute because I like to work my way down gradually. There's no rush. I wish the charts would hurry up. But there we go. Okay. So that area is here, and really what appears to be the 38.2 here is actually a resistance level. Let's take this out and replace it with just a good old line. Now look at that. Resistance. It's around 133.25. Resistance again around 133.25. So it acted as resistance on January 8th. And then again on January 17, 133.25 seems to be a big resistance level, 1.3325. All right, so if it can break through, and look how close we're getting. I mean, it's running toward it right now. If we can break through there, where does it go? Right? Is dollar CAD going to break out? Man, I needed to get above 25. I mean, let's call it 133.50 for the entry. I want this thing up above the old highs before I buy it. So 133.50 for the entry. I would like to be under support with the stop. Are you ready? Let's put a line in. I can't seem to draw that line. Why am I having so much trouble drawing that line? Here we go. Third time's the charm. There it is. I want my stop to be under this line. I'll make it a red line. First of all, hey, I didn't see your messages there. Hi, Al. Hi, Thomas. Thomas is asking, are you using a buy stop entry? The answer is yes. And it's a really good question. And let me explain what that means. 133.50 is where I don't want to buy it unless it can prove to me that it can make it up to 133.50. In other words, a typical limit order, you might get this type of a response from your platform. Oh, Ed wants to buy it at 133.50 or less. And it just gives it to me at the current price. But that defeats the purpose of what I'm trying to do. I want this thing to break out before I buy it. So Thomas is correct. It's called a buy stop order. You see, like I mentioned before, a typical limit order will
Hello, hey,
tell
all
you,
right, the sound is
it will say
okay.
it is 133.50 or less. And I'm saying stop. I don't want it unless I can get it at 133.50. So that's the way I always think of it mentally. Even think of the word stop. Now, that doesn't have to be this high. It doesn't have to be 133.50. It could be 133.40. I just want it above the old highs. Does that make sense? The old highs are 25, so if I go 40, I think I'm pretty clearly above those old highs, right? And I would like it if I can put the stop under this red line, because look at all the support there, right? So that red line is 132.36. So if I go with 132.30, that's a wide stop. It's 110. So I'd better have a lot of reward potential. And I think I do, because if you look at this, right? I mean, I'm risking 100, 110 to try to make 300, because look at this resistance area up here. Look at that. That's 136.50. You know, I got to get out before I hit that ceiling. But there's definitely a ceiling there at 136.50. Does everybody see it? I mean, that's pretty obvious, right? That there's something going on there. So I want to get out underneath 136.50. Let's call it 136.40. Now that gives me approximately 3 to 1 on my risk reward, but I'm not finished yet because I need to have more than one target here. But I like this target, 136.40, because it gets me out just before I encounter a very troublesome area of 136.50. Al says often when prices break a resistance, it goes back and retests. Yeah, I mean, that's a possibility too. So another way to play it could be, and Al's totally right here, we could buy the breakout at 133.40. Or we can allow it to break out and then buy it when it comes back to 133.25. That is also acceptable. The only problem I have with that is it might not come back. But Al's 100% correct. You can set up a buy at 133.25, but here's how you would do that. You would not set it up to buy now at 133.25. You first allow the price to rise up. Let's say to 133.40 or above. Then you put the order in to buy at 133.25, thinking that, hey, maybe the price comes back and tests this former resistance, which should now act as support, right? So I like it. I like Al's thought process here. Maybe I'll compromise. Let's compromise. I can compromise. I'll buy half on the breakout at 133.40, and I'll put in a buy order for the other half at 133.25, but only after I get filled at 133.40. Can we live with that? In other words, buy half at 133.40 first, then set up a buy order to buy at 133.25 in case it pulls back. I can live with this. Just going to make note here. Buy half at 13340 first, then attempt to buy half on a pullback to 13325. So look at Al getting in the mix here, right? Getting in on the action. Okay. And I love it when the students get in on the action. We've had tons of that here over the years. All right, as in this room. And I'm all for it. I don't care, man. It's all good. That's what we call being in a trading room. All right. Walter Peters would have called this a last kiss trade. Okay, now, I've actually met Walter. I don't know anything about his technique, but I remember meeting him. I think I met him in Barcelona a long time ago. But I think what he's saying is it breaks out, it comes back and gives one last kiss to 133.25, then off we go. Right. Now, the only issue is you never really know for sure that it's going to come back, but I am very comfortable putting in half at 133.40 and then the other half at 133.25 in that order. Very, very cool. Awesome job, everybody. All right, so I think we have our entry, and actually that's if we get filled on both of those entries, that lowers my entry price to around 133.33, which means my stop is almost exactly 100 pips. Because in other words, look at these two green numbers. The average of those, if they both get filled, then the average of those two numbers is the entry price. Okay. So we're talking about approximately a 100 pip stop and approximately a 300 pip target. So far I have two entries, 133.40 and 133.25. One stop at 132.30. One target at 136.40. And there's no way I'm not using 135. Because look at this. You see this right here? Just a little bit of resistance, and it's right near that round number. Son of a gun, right? Because we want one of our targets to be under that round number. And there's a little resistance right there. Actually, I should put that line right about here. So there's resistance at 134.72. Maybe I'll get out just prior to that at 134. Let's take one at 134.50. Because there's significant resistance at 134.70. And then there's the round number at 135. I'm getting out ahead of that stuff with part of the trade. Right, so right now it looks like two targets, two entries, one stop. Right, never a dull moment. And I could just go with this, but I like the idea of having. Now, here's the thing. The natural assumption is that I'm going to go half and half here, and maybe I will. But I don't have to go half and half. I could go 1/3, 2/3. If I enter a third target, that third target does not have to be 1/3, 1/3, 1/3. I could sell 1/10 at the first target and 2/5 at the second target and 2 more fifths at the third target. In other words, 20%, 40%, 40%. I do think there's value in doing this, in taking just a little bit off the table early in the game and then moving the stop up, and now you're playing with house money, and now you already have a small win to your credit, and now you can't lose. It's only a question of how much you're going to win. I really like to trade that way. I really, really do. So I may just enter a super easy target, you know, maybe just under 134. Not based on resistance, strictly based on that round number. You know, we haven't touched 134 in a while. So I might go 133.90. But here's the kicker. I'm only going to close a very small portion of the trade there. Let's say 20%. So instead of closing, I've got three targets here, right? Instead of closing one third, one third, one third, I'm going to close 20% at 133.90. I'm going to close an additional 30% at 134.50. Then for the big enchilada, way up high, I'm shooting for. I plan to take half my profits way up at 136.40, only 20% way down at 133.90, and only 30% at 134.50. Kind of an interesting setup, yeah? But, you know, I'm throwing some curveballs in there, a few things that I don't always show in here, because I hate to confuse people, but I can tell from the questions that I'm getting that folks here know what I'm talking about, so I'm not nervous about pulling out something a little bit more complex. I've got three targets, two entries, one stop on dollar Canada. There you see it all laid out in front of you. And man, if I can just make it to 133.90, if I can just make it there, I'm going to be so happy because I'm going to take profit with 20% of the position, and I'm going to move the stop up to let's say just under this black line here. I'll make it a dotted line. When we move the stop up, we'll eliminate almost all of the risk from the trade. Almost. Because I don't want to put the stop on above the breakout point. I want it to be just below. So, in other words, if we hit 133.90, the stop's going to come up to around here. Around there. Okay, we'll reduce the risk significantly. Okay. Now, that's about all the time we have for today. I hope everyone enjoyed that. Now, I have a few more notes to pass on to you before I go. Later this week, there are two events that should be on your calendar. You know, one is the European Central Bank press conference, which is up on Thursday morning, right around this time of day, but on Thursday instead of on Monday. So approximately 3 days from now, minus 1 hour. You're going to get the ECB meeting. You're going to get the speech from Mario Draghi, and that could be a big market mover. So that's the one thing that I'm really keeping my eye on. The other is Wednesday evening out of Australia. We're going to get Australia's version of non-farm payrolls on Wednesday evening. Okay, and that's usually a big market mover for Aussie dollar. They're looking for 18,000 jobs. Last month they had 37,000, but it almost always creates some volatility, and that's going to do it for me. I really enjoyed being in here with you. Thank you so much for your time and your questions. I really appreciate it. My name's Ed Ponsi. Thank you for listening. I'll see you again soon. Everybody have a great day.